beware the 10th of October, one of two possible remaining dates for the global reset. Is this just a coincidence, or are the globalists planning the reset on October 10th? Here's a compelling argument that the reset is less than 20 days away. This is an update to my August 12th post on Silver Doctors titled Beware August 15th, wherein I stated that the Rothschild-owned Economist magazine issue of January 1988 gave us a 30-year advance notice as to their planned currency reset. They made it quite clear in their cover illustration, with their Freemasonic phoenix rising from the burning pyre of paper fiat currencies, with a gold coin hanging around its neck, stamped 2018, with the bold cover title "Get Ready for a World Currency That We Should Prepare." I suggested in my August 12th article that if 2018 is their chosen year for the reset, that there were three possible dates yet in 2018 for the reset to occur, those being August 15th, October 10th, and November 11th. August 15th has come and gone, which leaves now October 10th and November 11th. For reasons mentioned in my prior article, August 15th is a very important date to the victors that run the world. Let us review, if anything of importance happened this August 15th. By reviewing the two charts below, you'll see that the US dollar abruptly peaked at 96.98 on that exact date, while gold abruptly bottomed at $1,160.73 at 8 p.m. on that exact date. Given the importance of that date to the victors, I believe this date was chosen to be their important turning points in these two highly manipulated markets. For those who have not read my prior Beware August 15th article, I stated that October 10th is another date that the Great Reset may occur because on this Economist magazine cover of January 1988, the gold coin hanging from the Freemasonic phoenix's neck is stamped 10/10/2018, which would lead us to believe their chosen date for their new world currency reset would occur on October 10th, 2018. Has anything changed since my prior article to point to this date as being more or less likely to be of importance? Maybe. Some people find it rather strange that all of us in the United States in possession of a cell phone are going to be getting a call from President Trump on our cell phones. This nationwide FEMA public emergency broadcast via cell phones was supposed to occur on September 20th, but for some reason that date has been changed to October 3rd. This date is exactly 7 days before the October 10th date. 7 is a very important number to the victors, who rely heavily on numerology, the Kabbalah, and Gematria for their planned events, and if you think otherwise, I encourage you to Google Christine Lagarde's speech of January 15, 2014 on the occult meaning of their magic number 7. So watch for October 10th and any important clues before this date for the coming Great Reset. The last date that I gave in my prior article for the reset to occur on was November 11th, which happens to be the 100th anniversary date of the end of World War I. As I had mentioned, the Great War ended exactly on November 11th at 11 a.m., 1918, because to the Freemasons 11 plus 11 plus 11 equals 33, which is their top degree, 33rd, in their secret society organization. This year is especially important to them because the centennial event happens on 11/11/2018, which in their numerology is 11 plus 11 plus 11 equals 33. President had planned on a huge military parade and ceremony for this event in Freemasonic Washington, D.C., as stated in my previous article, but has since cancelled it. He claims now that he will go to Paris instead for their huge planned event to commemorate this centennial affair. Paris is the Freemasonic heart of Europe, ever since their planned French Revolution of 1789. So watch for November 11th and any important clues before this date for the coming Great Reset. Oh yes, I think I had also mentioned that it just so happens that there are 33 days between October 10th and November 11th. Coincidence? ASX poised to rise in trade relief rally. Australian shares are poised to rebound in line with global markets amid a report China could ease the average tariffs on imports from a majority of its trading partners next month. ASX futures were up 22 points at 8:20 a.m. AEST. The US dollar was broadly lower, and the US 10-year yield ended little changed at 3.06%, despite a concerted selling wave in early New York trade, according to TD Securities, that pushed it toward 3.10%. Investors around the world are diving back into risk, LPL Financial said. The Australian dollar is pushing toward the US$73 mark, trading recently near its overnight peak. There is no local data this morning. It's been a good 24 hours for the NZ dollar. The NZD has pushed through topside resistance and has a bit of momentum here, ANZ Bank said. We retain a medium-term bearish bias, but don't think now is the time to fade this move just yet. The Kiwi was 1.1% higher at US$66.87 in recent local trade. China plans to cut tariff rates with the majority of its trading partners as soon as next month, as previously pledged, LPL said in a blog post. This move, coupled with pledges to increase foreign ownership of financial firms in China, highlights some areas of compromise in US-China talks and indicates a better tone for negotiations than recent media reports suggest, LPL also said. Shares on Wall Street advanced with both the Dow Jones and the S&P 500 resetting their respective record highs. The Dow was propelled higher by gains in Intel, Walgreens Boots and Caterpillar. 28 of the Dow's 30 components advanced. The Dow leapt 251 points to 26,656, surpassing the record high it set in late January. Both the S&P 500 and the Nasdaq have reset their record highs more recently. Less anxiety on the China trade front, and a fall in the dollar is helping rally, and I'd say we're back in the Goldilocks scenario again, Cliff Hodge, director of investments at Cornerstone Wealth in Charlotte, North Carolina, told Reuters. BlackRock's Larry Fink said he was optimistic too. I'm not really concerned about whether we'll see a setback. The markets have rallied since 2009, Fink said at a conference in New York. If you look at the markets today, we see a huge increase in corporate earnings on the back of tax cuts and a rising economy. Fink also observed that even as stock prices have risen, valuations have become more attractive for investors. The price/earnings multiple is lower today than it was a year ago, so the marketplace is now discounting some of those worries, he said. Some people may think they're discounting enough, but with P/E down, you could say the market is less expensive. Tech stocks were higher with 1% or higher gains recorded by Facebook, Alphabet, and Microsoft. Amazon rose 0.9%, Apple was up 0.8%. The U.S.-listed shares of both BHP and Rio also were higher. Rio was up 3.8% in New York. Rio's London-listed shares closed 2.5% higher. Rio yesterday announced $3.2 billion share buyback. Today's agenda. No local data. Overseas data. Japan National CPI August, Nikkei Manufacturing PMI September, Eurozone Market Manufacturing and Services PMIs for September, U.S. Market Manufacturing PMI September. Market highlights. SPI futures up 22 points or 0.4% to 6,188 at 8:20 a.m. AEST. Odd plus 0.4% to 72.89 U.S. cents. On Wall Street, Dow plus 1%, S&P 500 plus 0.8%, Nasdaq plus 1%. In New York, BHP plus 2%, Rio plus 3.8%, Atlassian plus 1.6%. In Europe, Stocks 50 plus 1%, FTSE plus 0.5%, CAC plus 1.1%, DAX plus 0.9%. Spot gold plus 0.1% $12.05.42 an ounce at 2:14 p.m. New York time. Brent crude minus 0.9% $78.68 a barrel. U.S. oil minus 0.5% $70.77 a barrel. Iron ore minus 0.4% $69.18 a ton. Daily and iron ore flat at 503 yuan. LME aluminium plus 0.8% $20.43 a ton. LME copper minus 0.6% $68.82 a ton. 2-year yield, US 2.80%, Australia 2.11%. 5-year yield, US 2.95%, Australia 2.28%. 10-year yield, US 3.06%, Australia 2.71%, Germany 0.47%. Australia 10-year yield gap, as of 8:20 a.m. AEST, 35 basis points. From today's Financial Review. Haymaker imp credit, house prices. Banking analysts are braced for the interim report of the Banking Royal Commission to restrict credit, which could apply more pressure to house prices. Active managers set to shine. UBS? Active fund managers are set to flourish over the next decade as aging Western populations create a drag on stock market returns and increase volatility. Australia most exposed to debt crisis. Australia's household debt to income has climbed rapidly ahead of other developed countries, leaving the country exposed to the next potential crisis, State Street warns. United States. S&P 500 poised to shuffle key companies. 20 companies including Facebook, Alphabet, and Netflix will find a new home within the S&P 500 as of Monday. U.S. Treasury yields, dollar disconnect. As global risk assets regain momentum, investors are driving Treasury yields toward 7-year highs and dumping the dollar at the same time. The Dow Jones Industrial Average hit a record closing high on Thursday, the last of Wall Street's major indexes to fully regain ground after a correction that began in January. Tech stocks led all three major U.S. indexes higher in a broad-based rally as trade worries subsided. The S&P 500 also hit a new closing high. Gains in chip makers and a 0.8% rise in Apple, which has drawn heart from the exclusion of some products from the U.S. tariffs on Monday, boosted the tech sector. The new record territories for the Dow and the S&P are fueled by lesser trade worries and just general enthusiasm about the economy, said Peter Cardillo, chief market economist at Spartan Capital Securities in New York. Among other stock moves, Under Armour rose after the sportswear maker said it would cut about 400 jobs as part of efforts to cut costs to compete with Nike and Germany's Adidas in North America. Europe. The Pan-European STOXX 600 closed up 0.7%, while the leading Eurozone stock index scored its ninth straight session of gains, up 1.1%, its best performance in 2 months. A positive open on Wall Street, where the Dow Industrial Average reached a record high, helped European indexes accelerate, even if these gains are merely side orders compared with the ongoing wealth creation seen in U.S. stocks. IG analyst Chris Beauchamp said. Autos, banking, and mining sectors led gains as investors stayed resolutely focused on hopes that the latest shots in the trade war could drive the dispute towards resolution. Autos gained 1.8%, also helped by Kepler Cheuvreux upgrading its recommendation on the sector. On autos, valuations have reached historically low levels, pricing in a lot of bad news already, wrote Kepler Cheuvreux strategists. Luxury British car maker Aston Martin is seeking a price tag of up to $5.1 billion in its stock market debut next month and has geared up for any Brexit outcome, it said. The company, famed for making the sports car driven by fictional secret agent James Bond, said last month it planned to sell around 25% of its stock in the first initial public offering, IPO, by a British car maker for decades. A bookrunner for the IPO said late on Thursday the company had already received orders for all the stock on sale. A source familiar with the matter said that was at the bottom end of a price range valuing the company at $4.02 to $5.07 billion. Aston Martin hopes to announce the final price for its stock on or around October 3 and expects it to be admitted to the London Stock Exchange on or around October 8. Asia. Japanese stock bulls feeling redeemed. Japan's best 5-day stock market rally in almost 2 years has got bears baffled. A rebound in Chinese stocks is proving short-lived. Hong Kong and Shanghai shares were little changed on Thursday, after rallying in the previous 2 days on optimism China's government would ramp up spending to offset the impact of U.S. tariffs. While speculation state-backed funds were buying shares had added to the upbeat sentiment, as did comments by Premier Li Keqiang that there would be no yuan devaluation. Other factors are less supportive of a sustained rally. Hong Kong stocks ended higher for a third straight session on Thursday, helped by consumer and technology shares. The Hang Seng Index ended 0.3% higher at 27,477.67, while the China Enterprises Index closed 0.5% firmer at 10,792.59 points. The Shanghai Composite Index dropped less than 0.1%. Industrial and energy companies, which had led the gains earlier in the week, were among the biggest losers. News that China plans to cut the average tariff rate that it charges on imports from the majority of its trading partners had little impact. Meituan rose 5% on debut in Hong Kong on Thursday, valuing the Chinese online food delivery to ticketing services firm at about $55 billion, and sending a positive signal to companies lining up to list in the financial hub. The stock's performance is being seen as a test of investor appetite for Hong Kong listings against a backdrop of weak markets and multi-billion-dollar initial public offerings that have struggled to rise above their issue price, such as smartphone makers Xiaomi and China Tower. In Tokyo, the Nikkei inched up 0.01% to 23,674.93, just about staying in the positive for the fifth day. The stock market barely blinked after a well-anticipated win by Japanese Prime Minister Shinzo Abe in a ruling party leadership vote. The margin of Prime Minister Abe's leadership vote was largely in line with expectations. The vote result is not something that looks to have a strong market impact, said Yoshinori Ogawa, senior strategist at Okasan Securities. The market is now looking a little overextended, and it is quite natural for profit-taking to emerge under such circumstances. Currencies. ECB must detail longer-term rate expectations. Peter Prate's comments add to the argument for more extensive guidance to ensure that investors continue to price only very slow policy normalization. The US dollar fell across the board as a resurgence in global risk appetite on relief that new US and Chinese tariffs on reciprocal imports were less harsh than feared hurt safe haven demand for the greenback. The dollar has been a major beneficiary of growing trade-related tensions in recent months, as investors bet it would gain at the expense of riskier currencies. After a knee-jerk negative reaction to the new tariffs announced by Washington and Beijing this week, currency markets have become more settled as traders say they do not expect the dispute to cause a global shock, at least for now. With news such as recent solid U.S. economic data and a likely rate hike by the Federal Reserve next week priced in, dollar bills are struggling for other reasons to push the greenback higher. Markets are realizing, at least in the short run here, there is not much more juice to squeeze out of the dollar, said Sean Osborne, chief FX strategist at Scotiabank in Toronto. The euro advanced 0.7% against the greenback. The dollar index, which measures the greenback against a basket of 6 major currencies, was down 0.5% at its lowest since early July. Emerging market currencies strengthened on Thursday, and the MSCI's emerging market currency index climbed to a 3-week high. With emerging markets stabilizing in recent days, the dollar is not getting as much of a lift from safe havens flows, said Osborne. To be sure, some market participants believe the dollar's weakness might be fleeting. I don't think this marks a new downtrend, and if it does, I think it will be quite short-lived because rate differentials still matter and U.S. fundamentals on a relative basis are still pretty strong, said Tim Graff, State Street Global Markets EMEA head of macro strategy. Commodities Vale is looking at expanding its flagship iron ore project in Brazil, a company official said, hoping to cash in on a growing appetite for higher-grade varieties of the commodity in its top market, China. China, the world's biggest consumer of the steel-making ingredient, has ramped up buying of higher quality, less pollutant grades of iron ore, as it battles to clear its notoriously smoggy skies. Peter Poppinga, executive director at Vale, said at an industry conference in China that the world's largest iron ore miner was studying expanding its S11D project in the Amazonian state of Pará, even though it was still being brought up to the planned capacity after it was inaugurated in December 2016. Given all these quality trends that are favorable to us, we are studying to increase the project, but there are no numbers yet, Poppinga said. Benchmark copper on the London Metal Exchange closed down 0.6% at $68.82 a ton. Copper has slumped 18% since touching a 4.5-year peak of $73.48 in June, but has recovered 5% from a 1-year low of $57.73 in August. Global primary aluminium output edged up by 0.16% month-on-month to 5.485 million tons in August, while Chinese production was estimated to have risen by 0.16% to 3.12 million tons, data showed on Thursday. LME aluminium gained 0.8% to finish at $20.43 a ton. Investors are awaiting new impetus after the price ended back at the lower range of the corridor of between $2,000 and $2,200, in which it has been trading since July. High Chinese supply continues to weigh on its price, Commerzbank said in a note. Australian share market. Aussie equities outlook is average. Mark Landau says few of the largest ASX companies are worth buying, but he likes those exposed to the infrastructure and tourism booms. Australian shares closed lower on a volatile day of trading as the supermarkets and banks wiped gains made by the materials sector. The S&P/ASX 200 index closed 20.5 points, or 0.3%, lower at 6,169.5 points, despite the market rallying several times throughout the session. The major supermarkets led the market losses on Thursday. Woolworths announced that it would be introducing a milk price levy, lifting the 3-liter house brand milk from $3 to $3.30 until mid-October in order to assist drought-ravaged farmers. JPY and USD under pressure, while the NZD has made further gains overnight, adding to the move. After stronger-than-expected GDP figures, U.S. Treasury rates have consolidated around recent highs. U.S. data showed unemployment claims falling to a 48-year low. Positive risk sentiment sees JPY and USD under pressure, while the NZD has made further gains overnight, adding to the move. After stronger-than-expected GDP figures, U.S. Treasury rates have consolidated around recent highs. Markets are still in a positive mood since Trump opted for a more moderate tariff imposed on China earlier this week. With that risk event cleared, the rally enjoyed by risk assets continues. U.S. equities have reached a fresh record, with the S&P 500 up 0.8%, and the USD remains under pressure. The recent rise in U.S. rates across the curve has done nothing to support the USD, and traders are still likely reducing their long dollar positions that have been built up this year. The U.S. 10-year rate had another look at 3.09% overnight, the same high as the previous session, but has peeled off to be up less than 1 BP to 3.07%. Key USD indices are down 0.4 to 0.6% for the day, and are close to technical support levels, threatening to break lower. The flip side of a weak USD is a more positive dynamic for emerging market currencies, with JP Morgan SMFX index up 0.8%, making it the 7th positive day out of the last 8 days. Supporting better sentiment for riskier currencies, in a speech earlier this week, President Xi said that China would reduce tariffs, and yesterday's sources indicated that average tariff rates would be cut on imports from the majority of its trading partners as soon as next month. It will be interesting to see how U.S. imports are dealt with, as WTO rules for countries with the most favored nation status stipulate that any reduction in tariffs usually must be offered to all countries equally. Supporting risk sentiment, overnight economic news was generally positive. Weekly U.S. data showed unemployment claims falling to a 48-year low, suggesting an ever-tightening labor market, while the Bloomberg Consumer Comfort Index showed confidence rising to a fresh 17-year high. The Philly Fed Business Confidence Index came in stronger than expected, albeit still likely points to a weaker ISM index, while soft U.S. existing home sales continues to paint a picture of a flat housing market against a backdrop of rising interest rates. UK retail sales data were stronger than expected, with upward revisions. As expected, Norway's central bank raised rates for the first time in 7 years. The bank flagged it will raise rates again at the start of next year, but also unexpectedly lowered its longer-term projections, and this saw NOK underperform alongside the USD and JPY. Higher risk appetite continues to act as a tailwind for the NZD, and it is trading close to its highs for the day, near 0.6690. The first level of technical resistance kicks in around the 0.6725 mark, ahead of 0.6860. The discount 2-hour short-term fair value estimate is closing, but there is still a gap to that model-based estimate of just under the 0.70 mark. Apart from the stronger risk appetite backdrop, yesterday the NZD got a boost after stronger-than-expected Q2 GDP data. The figure came in at 1.0% Q/Q, the best quarter in 2 years, and as well as beating the market consensus of 0.8%, the upward surprise relative to the RBNZ's estimate of 0.5% was the greatest in more than 5 years. The data provided no evidence to support the notion that the economy has hit a pothole. Weak business surveys might well indicate where the balance of risk lies regarding the economy, but have so far proven to be an unreliable steer on actual activity. The strong data dampened market expectations for future OCR rate cuts, with OIS pricing for the August 2019 meeting up 3 bps to now suggest just a 25% chance of a rate cut by then. The 2-year swap rate ended the day up 3 bps to 2.035%, while 5 to 10-year swap rates were up in the order of 4 to 4.5 bps. The strength of the NZD post the GDP release has been sustained, which sees the NZD up on all the key crosses, ranging from 0.2% against GBP and EUR to 1.3% on NZD/JPY. GBP has performed well despite negative headlines on Brexit overnight. The lead story on the FT is EU ambushes May over Brexit plan. It looks like the EU and UK have reached an impasse at the Salzburg summit. EU leaders warned PM May that her economic plan for Brexit will not work and gave her 4 weeks to save the exit talks. French President Macron said that no blind deal will be done with the UK. Are we going to see a global currency reset? The case for something like a global currency reset is interesting and harks back to the darkest financial days of recent times. In 2008, as the world economy was teetering on the edge of the abyss, thoughts were moving towards how this situation could have occurred and how to prevent this occurrence in the future. Recently I read an article discussing the inevitability of a global currency reevaluation and reset. For most observers and even many traders, the first questions that comes to mind is not the merits or failings of such an issue, but something much more fundamental. What is a global currency reset? There is a reason that most people are not familiar with the concept. That is, because it is something that has rarely been used in recent history. Only once in the last 100 years, after World War II, with the fear of another Great Depression in the air, and a note of conciliation in the collective minds of politicians the world over, at the famous Bretton Woods Conference, was this achieved. It was effective in preventing another depression, and in fact, the years post-World War II saw strong economic recovery, as the world recovered from its wartime slump and industry exploded. It was also a unique confluence of circumstances. The world had been decimated by war, and countries had come together collectively to fight a common enemy. It was the last time that much of the world had stopped thinking exclusively about sovereign interests and banded together for international goals. The lives of foreign nationals became important, and armies fought for and protected the lands of their neighbors. Politicians had become used to thinking about the interests of their allies. This alone made it a unique time in history for collaborative action and collaborative will. The reason this is relevant is because a global currency reset is where all the nations, or at least a vast majority, agree to one currency standard, like gold, for example. The critical factor is agreement between countries, which is only ever achieved when the needs and interests of those countries are aligned. The case for something like a global currency reset is interesting and harks back to the darkest financial days of recent times. In 2008, as the world economy was teetering on the edge of the abyss, thoughts were moving towards how this situation could have occurred and how to prevent this occurrence in the future. The leaders of the world wanted to create a situation where irresponsible activities in another country did not destroy their economy. Post-Bretton Woods, the main reserve currency held by countries was the US dollar, yet another reason that worldwide financial issues were so encompassing. Would a reset be the solution? Ultimately, the world did not go that way. Post-World War II was a unique time where not only was there a global consensus but also mutual interest. Post-2008, the mutual interest was lacking. The simple fact that some countries would have benefited less from a global reset meant that it would take significant political will to undermine this element, to surrender control of monetary policy because of the failures of another country would be unthinkable politically. Resets would limit the ability of central banks, a major point of friction that is playing out in Europe. Not to mention the fighting that would arise amongst countries trying to set the new standard. Just think of the varying positions and interests of Russia, China, and the USA, and you can imagine how easily this would be solved. Is the world likely to see another global currency reset? Honestly, it would take a worldwide disaster the level of World War II to bring together the world for a reset. So if a reset does become a reality, we can probably agree that it is likely to be the least of our problems.